You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, my co-host John McEwen. In this week's episode, we're going to be talking about Barratt Developments, Next, M&S, Sainsburys and Morrisons. So John, should I start us off with Barratt Developments?
Yeah, kick off with Barratt, Sam.
So Barratt Developments, who for anyone who don't know, are a residential property developer, have released a trading statement. So the main points from it are, during the first half, they completed on 9,077 homes, which was a 9.2% increase from the same period last year. The sales rate rose to 0.77 per outlet per week, which was up from 0.69 per outlet per week in 2019. They said the newest lockdown has only forced their Welsh sales offices to close. Board plans to resume dividend payments, with interim dividends to be announced on the 4th of February alongside the interim results. So the lockdowns during the first half of the year contributed to an 8.1% decline in active outlets compared to the previous year. And pent-up demand, coupled with the stamp duty holiday at the end of the year, at the end of Help to Buy, means the group is actually entering the third quarter with reduced product availability. They bought 5,635 new plots on 35 sites between August and January, and they intend to continue with their land purchasing strategy to develop a land bank of around 4.5 years. Their forward order book accounts for roughly 90% of their expected completions for 2021. The group's total average selling price rose 1.1%, and its private average selling price showed a 2.2% increase to £319,000. They had £1.1 billion in net cash at the end of the period, which was up from £308 million at the end of June. So that's down to a decline in work in progress, although they said they expect investment to increase in the second half of the year. It's worth noting that one key thing as well is the current form of Help to Buy is due to come to an end in 2021, and that scheme is used by about 51% of Barratt buyers. And Barratt have said they want the government to consider further help for first-time buyers, which is unsurprising given what a large proportion of their buyers use it. In terms of their valuation, they're trading at a forward price to earnings ratio of 12.2, and that compares to a 10-year average of 10.6. And they're trading at a prospective dividend yield of 3.6%. And as previously mentioned, management has announced plans for the resumption of dividend payments, and they're expected to equal 40% of profits for the year. In terms of the business itself, they trade at a market cap of £7.33 billion. The share price is about £7.20 at the minute, and the share price has a 52-week low of £3.49 and a 52-week high at £8.89. So it's now a lot closer to the highs of the year than the lows that we saw in March. In terms of the financials, just looking at the last 5 years of full year accounts, so the periods from covering 30 June 2016 all the way to and including 30 June 2020, it looks pretty good over the last 5 years, but given it's a property developer, it's to bear in mind that that's on the back of a very strong housing market. So you would expect that given where we are in the cycle. My conclusion on it was, it seems quite well positioned. It seems to be in pretty good shape, but it does look quite expensive in my opinion. What are your thoughts, John?
I like the house builders at the moment, and I do quite like Barratt. You think it's pricey? Do you think it's pricey on the basis of what it is for a house builder at this time in the cycle? What do you mean by that?
Well, yeah, the forward price to earnings ratio of 12.2, that's quite high for a house builder, especially given where we are in the cycle, where it's, very, very, it's very profitable. I just think with Help to Buy coming to an end, the fact that it's quite expensive compared to historic levels, it's not far off where it was before the big drop due to coronavirus. It's not really trading at anything of a discount, and there is a lot of uncertainty. I don't think it's impossible that they don't have enough supply to meet demand if things carry on as they are. I just think it looks like a good business. It looks like they're doing well, but I just think it looks expensive for where we are in the cycle.
Yeah, but I suppose that's, the structural imbalance that we have a huge demand for housing and not much supply. And particularly with young people wanting to buy houses and get on the housing market, and that the government is likely to be continuing with the Help to Buy in some form, even if it's not as generous as it has been. And that would sort of come into line probably with their policy of sort of levelling up. So I'd probably be a bit more optimistic, despite the uncertainty, that one of the things that we could probably be more certain of is government support of the house building sector, which for companies like Barratt and the other big house builders have really made massive profits off the back of that. And I think it's probably something that is likely to continue in the near term. And with forward price to earnings of sort of around 12 doesn't seem that much to me. I appreciate there are uncertainties, and like you say, that after Corona, we're at similar valuations to where we were prior to it. When you put it like that, that does maybe sow some sort of seed, but I still like it. I'd still be bullish on the house builders at the moment.
What do you think of the dividend yield? Because the prospective yield of 3.6% is very respectable. But again, it's the same point for a house builder where we are in the cycle. I mean, it wasn't uncommon, was it, for those yields to be more like 5 or 6% a couple of years ago?
Oh, well, high, 7%. No, that's right. And I suppose it's sort of relative to the price as well. I'm not sure where it was trading, back in sort of 2019 when there were the ups and downs of the Brexit debate. But it's not a massive dividend, that's for sure. But I don't know what their dividend policy is.
Well, they did say 40% of profits, but again, that does mean that, when you're getting 3.6% now, and like I say, given where we are in the cycle,
I take your point. Yeah,
at the bottom of the cycle, it's not going to be it's not going to be near 3.6%, is it? A lot of what the management has done, I think the business seems to have been managed well in the past year. And that's possibly part of the reason why it's trading at the premium. I mean, the fact that they've been able to build up that land bank without having to dilute shareholders like maybe some of the other house builders have.
Taylor Wimpey.
Yeah.
We talked about a few weeks ago. Yeah.
So I probably prefer it to Taylor Wimpey.
Fair comment. So is it one that you'll be buying?
It's not one I'll be buying, but that's not a criticism of the business. It's just the valuation for me. Okay, fair enough. Well, I think for me, I don't know whether I'll be adding. I do have a house builder already, so I probably won't be adding or buying Barratt in particular. But I'm not. I'm still happy to hold it. So, should we move on to the supermarkets?
We'll start with M&S, and then we can go on to Morrisons and Sainsburys, the sort of, I suppose, more traditional supermarkets. So M&S, often seen as a bellwether retailer and one that's attempting a turnaround. They've said in their statement that the COVID restrictions in the run-up to Christmas dragged the clothing sales down by a quarter, 25.1% to 787 million over the 13 weeks to Boxing Day. And like-for-like sales were down 24.1%, which was roughly in line with what analysts had been forecasting. And the M&S clothes shops suffered a 46.5% fall in sales. And that was partly offset by the growth of online sales of 47.5%. And they say that, the improvement on social media and the ability to ship products that had been trapped in those closed stores to their online customers. And the company, interestingly, claimed that prior to the November restrictions were introduced, so this 1 month lockdown, its clothing and home sales were only down 16.8%. And that also, after this 1 month lockdown, they recovered to only 19.8% down compared with the December from the previous year. So more positively from the business, and this has been the story probably over the last 10 years at least, the company's food business reported a 2.2% rise in sales to 1.7 billion for the third quarter, and like-for-like sales were 2.6% higher, which did beat analysts' expectations. And they'd said that if the closure of the 400 cafes was stripped out, its like-for-like sales were 5.7% higher. And in the 4 weeks to Christmas, after the lockdown, they were up 8.7% if you take those 400 closures out. And they added that the growth was largely driven by the popularity of the retail park shops and the Simply Food outlets. And they were quite proud of the results, with Steve Rowe, the chief executive, saying that it was near impossible conditions. So given that, we should sort of really be impressed by them. Their international sales were down about 10.4%. And there was a quote from Richard Lim, who's the chief executive of the Analyst Retail Economics Group, saying that the clothing and home sales were dealt a sharp blow against a backdrop of zigzag lockdown policies over the Christmas period. But as shops were forced to close, consumers embraced the online channel, which saw the retailer develop impressive growth. It's taken some time to get the online channel fired up, but the retailer M&S that is, appears to have benefited from a new wave of online shoppers. And the shares were up about 2% on the day. So not great results, but possibly slightly better than were predicted and were expected. What do you think of M&S as a business, Sam?
I wasn't particularly impressed with it the last time we talked about it. So the last time we talked about it was after they'd released their results for the last half. And those results included the first ever loss for M&S as a public company and a 15% decline in revenue. However, the clothes and home was down 40.8% in that period. So it's not, I know they're very proud of these results and they're talking about these pockets of improvement, but it's not really much better. So I guess the 15% overall is now just an 8.4% overall decline, but clothes and home seems to be just as bad.
Yeah.
And it's now more expensive as well. The best thing you can say about the results is they're not as bad as they were.
Yes.
But they're still bad. And I think the fact that management seems to be proud of them is concerning.
Yes, I would completely agree with you. And I just can't get my head around the sort of the clothes and particularly the clothes side of the business. You just wonder at what point they cut their losses with it, because it feels like every year for at least the last 15 years. I remember as a teenager watching the news and listening to the latest chief executive saying that they were going to turn around the clothes side of the business. And it seems to fail every single time. It still has the same image problem. And it never seems to do well. It seems to drag down the other side of the business, which is the more successful food side. But at what point they cut that out, I don't know. It feels, you're flogging a dead horse.
There's quite a lot of debt as well on the balance sheet, was one thing that I noticed.
Do you have the figures?
So the long-term borrowings on the balance sheet, and the figures I've got, it's only at 28 of March 2020. So I think it's actually gotten worse. I know that they issued a £300 million bond during this latest period with a maturity date of 2026. But at March 2020, they had long-term debt on the balance sheet of just under 4 billion. And that's jumped quite a bit in the last. So it was around 1.6 billion in 2018, and then it jumped up to 3.6 billion. And that must have been for the Ocado purchase.
Yes.
And that just on the back of how the business is performing, to me, it looks like a poor decision. But I guess you'd say, well, Ocado's booming away and the share price is doing really well. So so you've got that asset on the other side. But if Ocado doesn't perform, or the share price, or if the valuation drops, I think that decision looks very questionable.
Yeah, no, I would agree with you there.
Especially when the business just isn't in a position to be, they're not booming away. So to take on all that debt for something that, as we've talked about before, is very richly valued. It's a gamble.
It's a massive gamble. And then the business that you'd be left with is not, aside from the food business, is not a very attractive proposition, I don't think.
It just feels like they don't really know what to do.
Yes. Yeah.
Because you talk about sorting out the clothing and home, and then you've got the Ocado purchase, and
you've got all the expenses associated with bricks and mortar and pensions and et cetera, et cetera. It's a lot of costs Yeah.
It's actually trading at a PE ratio that's slightly higher than the 10-year average as well.
Yeah.
Which you wouldn't.
I mean, it has been in pretty dire straits for the last 10 years, albeit it hadn't made the loss until earlier this year. But it's, been a business on the down.
Tempt you at a PE ratio of 13?
No. You?
Right, well, no, definitely not.
Definitely not, no. So Morrisons, the next or the first, depending on how you consider M&S supermarket. So they reported a rise of 8.1% in sales over the 20 weeks to January the 2nd. And over the critical 3 week to Christmas, sales rose 9.3%. Morrisons was helped by the strong online growth, and they sort of established that really over the last few years with Amazon and Ocado. That was a very positive factor for them in this period. And the wholesale business, which supplies 1,300 McCall's convenience stores, grew like-for-like sales 24.4% in the fourth quarter, which contributed to a 1.2% group like-for-like sales growth. And there are plans to add another 100 McCall's stores to that portfolio. So it was largely a sort of positive statement from Morrisons. And for context, they're Britain's fourth largest supermarket with about a 10% stake of the UK's food market. And on the day, shares were flat. I think they closed about 0.3% down, but there wasn't much movement there. In terms of Sainsburys, on the other hand, their statement in the third quarter with group like-for-like sales, excluding fuel, they rose 8.6%. And there'd also been a number of significant rise in online orders. And Sainsbury's reported that they were expecting full year underlying pre-tax profits of at least 330 million. And that includes the repayment of 410 million in business rates relief that they'd received over the COVID period. And shares a bit more positive on that note, rising 4% on the day. So there are sort of two supermarkets there. In terms of the valuation of them, Sainsbury's is trading at a price to earnings of about 12 or 12.4 with a prospective dividend yield of nearly 5%. Morrisons, on the other hand, is trading at a very slightly more expensive price to earnings of 13 and prospective yield of just over 5%, 5.2. But Morrisons is the smallest of the big four retailers. You recently did some research on Tesco's individually.
Yeah, I liked it. I thought there was a lot to like about it.
And we've discussed it on a previous episode as well.
We were very positive. I mean, it went into the fantasy portfolio that we did a couple of weeks ago as well.
What do you think of Morrisons and, Sainsbury's and Morrisons in comparison with Tesco's?
I don't think either of them were probably as good, but that's reflected in the fact that they are trading. I think Tesco's is it quite close? It's quite close to a PE of about 20, isn't it, compared to 12 and 13 for these two?
Yeah, it's trading at a PE of just over 21 now.
Yeah,
so
I thought it's probably the better business. Sainsbury's, we have talked about that before, and last time when we looked at the half-year results to the end of September, they had a loss of 137 million, but they did say that included 438 million of one-off costs, and that does seem to be the case. So they said last time they had an underlying profit of 301 million. So they've said underlying 330 million now, and that was excluding Argos, which has been a bit of a drag. But I mean, based on the Sainsbury's results now, Argos seems to be doing a bit better. Yeah, it seems to be doing a bit better, but it's a bit similar to M&S, where I just think it's still quite an unattractive business. Morrisons, I did quite like. I don't know if it's just because it's a bit more of a pure play, whereas Sainsbury's and M&S both have other elements to the business that I'd consider quite undesirable, whereas Morrisons is just more of a pure play supermarket. Morrisons online sales, they were up about 300%, weren't they? But that was from a much smaller base.
Much smaller base, yeah.
Yeah. And Morrisons also said that all brand and customer metrics had improved and market share had been gained. So they seem to be doing a better job, I think. And given that it's trading at about the same value, about the same price of earnings as Sainsbury's, I don't really understand why you wouldn't go with Morrisons if you're choosing between the two. That being said, if you're including Tesco, I think in terms of the businesses, I'd probably prefer Tesco, but you've got that more expensive price to earnings to consider as well. One thing that I thought was interesting with Morrisons is that they're selling their products on Amazon. So they've got their deal with Amazon. And I think whilst you shouldn't buy a business because you think a takeover is possible, I think when you look at what Amazon have done with Whole Foods in America, I don't think it's inconceivable that they could buy Morrisons.
Yeah, and it wouldn't be a big acquisition from their perspective for full entry into the UK market.
And they could just do the same thing that they've done with Whole Foods in America, and it would seem to fit that quite well. So there would be that possibility of a buyout, and like I say, you shouldn't buy it because you think that's going to happen. But if you like the business as well, then that's potentially a nice little bonus, or not, depending on the price,
Yes,
I guess.
and
but
not that we're speculating, but now might be sort of a ripe time for companies to buy into the UK after a Brexit deal has been done. There's more certainty in the market.
Yeah, so, I mean, there's nothing to suggest it's going to happen, but it's not inconceivable, is it? It would make quite a lot of sense.
No, that's right.
But yeah,
and we've probably been lacking of acquisitions over the last couple of years, really.
I quite liked Morrisons. I thought it seemed like a decent business. The valuation seemed quite fair. So again, it's got quite a bit of debt on the balance sheet, but it's certainly not as bad as M&S, and it seems to be fairly manageable. So yeah, I did quite like it.
Good. Well, I suppose we've got our fantasy portfolio now, but it's probably one to watch.
It would, yeah. I would. It probably will go on the watch list. Actually, I did quite like it as a business.
Good. Okay.
What did you think?
So, I did. No, I mean, look, the points that you make, I think, are very valid. It's not as though I'm covering it, looking for a supermarket at the moment, just because I've held for a number of years Tesco's. It's been painful at times holding Tesco, sort of after the accounting scandal and things back in 2014. But now I've seen the turnaround happen, skeptical about it at many points. But when they got Dave Lewis in, Drastic Dave, he does really seem to have made it into a better business, and he's left it in a better shape, much better shape than he found it. And it's one of those things that I'd always thought that it was sort of a lesson in the portfolio, just seeing that and seeing when the numbers aren't right and you can't trust the numbers, what that does to the credibility of the business, and a business that was struggling to now what's a much more robust looking and what is Britain's biggest retailer. So I'm actually quite happy holding that. And I don't really feel the need to add any more exposure to retail in the UK in my own portfolio. But I think probably of those two that we mentioned, if we exclude M&S from it, so we just looked at Sainsburys and Morrisons. Yeah, I agree with the pure play side of Morrisons. And I mean, Tesco's was one of those it was very bloated, 5 or 10 years ago, and seemed to be trying to expand into just about every avenue it possibly could, which worked out very badly for it. But it's sort of, stripped itself back to the core and is in much better shape after that. So yeah, I'd probably be opting for Morrisons if I were to choose between Sainsburys and Morrisons, those two. And I suppose at the moment, things are relatively benign. There's not too much of a supermarket price wars going on, which probably between 2015 and certainly 2018 was one of the big problems for all of the big four, and that their margins were sort of eroded by the entry and to some extent dominance of Aldi and Lidl in the sort of budget sector. And I suppose it allowed those big four to become quite lazy and just enjoy sort of 10% margins on a lot of their products, and then that was sort of stripped back down to very low single digits. But thankfully for the investors, that hasn't returned. I think it was probably a very good thing for the consumers, and it kept food prices down when you might have seen a bit more inflation on that side of things. But yeah, at the moment, I would have thought Morrisons or even Tesco's, but like you say, valuation's a bit more expensive, would be reasonable plays in the supermarket space.
Okay, so should we move on to our final company?
So final company, yes. So another retailer, we've got Next.
Yes, so Next have issued their Q4 trading statement. They've reported a decline in full price sales of 1.1% in the 9 weeks to 26 December, which was a lot better than the guidance they'd previously issued, which was for an 8% decline For the full year, said full price sales up to 26 December were 16.5% lower than last year, reflecting disruption at the start of the year. However, the better than expected sales in November and December mean that underlying full year profits are expected to come in at 370 million. For the fourth quarter, the sales saw a 38% increase in online sales, which was made up of a 36% increase in the UK and 43% increase overseas. And that offset most of a 43% decline in shop sales over the same period. And for the year as a whole, online sales rose 10%, which was made up of 9% in the UK and 13% overseas, whilst in-store sales fell 46%. Their return rates are much lower than last year, but that's more reflective of a shift to lower return product areas, such as loungewear, for example, which is doing a lot better with everyone sat at home. Their surplus stock going into this end of season sale was 12% lower than last year. However, the fact that they're going to have to do the clearance sales online will increase the costs associated with the sales of what's left. They've said out of town retail parks have continued to do better than those in city centres and shopping centres. Meanwhile, the total number of active online customers rose to 8.2 million, which was a 24.1% increase from last year. That reflects a 24.6% increase in UK customers, which is now 6.3 million, and a 22.4% increase in overseas customers, which is now 1.9 million. Interestingly, they've said the number of customers making purchases on credit recovered in the second half and continued to grow in the run up to Christmas, and now is now up 2% on last year. However, default rates are still below the level seen last year, which I wouldn't have expected.
No.
They said they now expect. Well, yeah, I guess, yeah. It's all that free money, isn't it? They've said they now expect 370 million of full year underlying profits before tax, and the effect of an extra 53rd week in the year and write-downs in property value means reported profit before tax is expected to be 342 million, and the year-end net debt is expected to fall 487 million down to 625 million, which is a very big drop. I was quite impressed with this. I mean, Next, it's been it's been doing well for a while anyway, but I was surprised as well that the overseas customers were so high. I didn't realize they had a presence in Europe, Asia, and the Middle East.
No, again, I hadn't realized that. I thought it was much more, well, almost exclusively British based, and it didn't have such an overseas following.
No.
It's been, certainly very, very positive. And I think the market, a similar reaction, the shares were up 8% on the day. Next has been a business that used to have, well, it probably still does have a catalogue, but it was used to doing that sort of mail order side of things. So I think it's probably a shift to online has been easier than some of these other companies, some of the more traditional bricks and mortar retailers. I don't know what you think about that.
Yeah, I'd agree with that. So yeah, it's like you said, it's a business that's doing very well, and that is unfortunately reflected in the price. So it's now trading at a price to earnings ratio of 17.6, and that compares to a 10-year average of 13.4. And this prospective dividend yield for the next 12 months is at 2.4%. I mean, it is expensive. It's actually at a 52-week high, market cap of 10 billion, but I guess that is because the business is performing. You could have, so the share price is about £76 a share at the minute, but you had the chance to buy it under £40 a share in March, which.
Yeah. And if we look at it, the share price certainly over the last 10 years, and this is excluding any dividends, it's done about 263%. So in comparison with the overall, the FTSE 100, it's absolutely smashed it. So it's not as though it's a business that looks a little bit expensive on paper and has never delivered. It does have a track record of delivering.
I guess you'd say in the past 5 years, it's not done as well.
No, it hasn't done it as well in the past 5 years.
But it has dealt quite well with the change. I guess there's been more of a shift to online in the past 5 years, and you've obviously got Amazon is a lot stronger now than it was 5 years ago, although it was still very strong then.
Yeah.
But in that period, revenue has basically remained flat. It's down slightly, but they've actually managed to slightly increase over that period the earnings per share. So they've managed to hold their ground, which is not something a lot of retailers can say for the past 5 years.
Yeah. And it's recently, I think it's acquired about a well, in fact, it's a majority stake in Victoria's Secret in the UK branch or the UK arm of the business.
Do you know how much that is?
I'll have to Google it.
Do you think they haven't paid? So the articles I'm looking at, it says they formed a joint venture and they'll acquire the majority of the assets, but it looks like it gone into administration. So I think they got it for nothing.
Oh, right. Okay.
So it says they'll own 51% of the venture, whilst Victoria's Secrets will have 49%.
Well, if you fact check that one.
That seems like quite a good deal, I think.
Yeah, I would have thought so. And it's, I suppose, Victoria's Secret. Not that I know a lot about it, but it's quite a strong brand.
It is, yeah.
And it's, yeah.
Apparently, it fought off Marks and Spencer's to try and get it. Yeah.
Okay. I don't think Marks and Spencer's would have worked for Victoria's Secret's image at all. I think it would have really dragged that down, wouldn't it?
I suppose it supports what we were saying before about the business being lost.
Yeah, yes, that's it. That's it. But next on their website, I think they've got this something called a total platform, and customers get unlimited free next day deliveries for £20 a year.
I'm trying to check that they've not paid anything.
Well, it's interesting. So the chief executive at the moment, Wolfson, after graduating from Cambridge in law, he took a summer job at Next in West London in 1991, and then he climbed up in the business and became personal assistant to the last chief executive, David Jones.
That's what you want.
It is, isn't it?
I can't find, I mean, I've looked at about 5 different articles now and I can't see anything that mentions the purchase price.
Oh, no, well, don't worry about it. And under him, the Next share price has risen tenfold.
No, I like that acquisition, actually. I think it makes a lot more sense under Next, or for Next and Victoria's Secret to be working together than for M&S and Victoria's Secret.
Yes. Yeah. And the other thing with Next is that obviously their main product is their own brand, but online they do sell other designers as well.
Yeah. So and they do have a strong online platform as well.
Yeah. Yeah. And with that £20 a year subscription, I could see that appealing to a lot of, more loyal Next customers.
Yeah, I think it makes a lot of sense. Your thoughts on Next then?
I don't know whether I'd invest in it, but I like it. I think I'll probably watch it and do a bit more research into it. But it's not cheap, but it's attractive, I think.
No, I agree. It looks like, it's reflected in the price, isn't it? But it does look like a good business. It seems like it's under good management. It's got a clear sense of direction, unlike some of the businesses we've looked at today.
Yeah, that's it.
But it did look like a quality business. It's just not really in an industry that I'd particularly want, unless it was at a very attractive price.
It's a very tough industry. I think that's for sure. And retail, there's so much disruption going on in retail, and I don't know how many British retailers we've seen go to the wall this year, but we've had a number. I wouldn't think Next is going to be one of those, but it's very difficult to know.
I mean, it doesn't look like it based on how they've been performing recently anyway.
No, well, absolutely. That's right.
So of the 5 businesses that we've talked about today, Barratt Developments, Next, Marks and Spencer, Morrisons, and Sainsburys, if you had to buy one, which one would it be and why? And forgetting anything else that might already be in your portfolio.
So that's a tough one, because I think I've got 3 that I do like. I quite like Barratt, Morrisons, and Next. For 2021, I'd probably go for Barratt. I think that would be my choice.
I'd go for Morrisons, but I was the same as you. I liked Next, Barratt, and Morrisons.
Yeah.
My only issues with Next and Barratt really were the valuation.
Yeah. But I think there's possibly there may be a bit of momentum going on this year, and I think that could probably benefit. Well, it could benefit all of them, but it could particularly, I think, benefit Barratt. But we'll see. We'll see what happens. But yeah, I wouldn't be averse to any of those individually. For our US section of the podcast, did you have some thoughts? You've been watching some old Berkshire Hathaway conferences.
Yeah. So for anyone, well, I expect most people don't know because they're not as sad as me, but there's a section on CNBC's website where they've actually got all the historic Berkshire Hathaway meetings. So for anyone who doesn't know, Berkshire Hathaway is Warren Buffett's company, and every year, not last year because of coronavirus, but it's basically like a mecca for investors where every year about 40,000 people turn up for this annual shareholders meeting, which I don't think there's any other companies that come close to that I'm aware of. And during this meeting, there's basically a 6-hour Q&A with Warren Buffett and the chairman, Charlie Munger. And it's fantastic. So I've watched it every year since they started live streaming it in 2016. And then I only recently found out that they've actually got video recordings of every year going back to 1994 on a section of CNBC's website. I'll just find the link for anyone who's interested. Oh, here we go. It's called the Warren Buffett Archive. So it'd be buffett.cnbc.com/Warren-Buffett-archive. And they've got all sorts on there, actually. They've got a documentary on there. They've got CNBC interviews. They've got a Buffett A to Z. But there's a section for annual meetings, and it's got every single meeting going back to 1994, and they really are fantastic. So I've been working through one meeting a week because, like I said, they're about 6 hours, and I'm up to I finished 2005 this weekend. I just thought that's worth talking about.
Were there any particular pearls of wisdom that you picked out from?
I mean, there's a lot that goes over from year to year, but the main takeaway for me has been that when they're talking about the best businesses that they've bought and the ones they like the most, and the ones they refer to as almost like the permanent holdings in the portfolio, they're just businesses that to them are just absolutely obvious. So that the most famous example would be Coca-Cola, where Buffett completely understands that business. He completely understands where it's going. And to him, it just seems obvious that it's a business that is a wonderful business and is going to do well. So if I had to come up with another business that for me fit in that category, I'd say the first business that comes to mind for me is probably Disney. But then you'd possibly have something like a Unilever in there, where it's just such a quality business that it's very, very difficult to do badly on it if you're holding it for the long term. And that's not to say price isn't important, but when you've got such a wonderful business, I think it's very useful for helping to identify those businesses. So they are the businesses with clear moats and that you understand the best. So for me, a business that I own that I think does fall into that category would be Etsy. There's quite a few businesses I own that thinking about it are not obvious. And that doesn't mean you can't do very well in them, but there are some businesses where it just seems obvious that in the long term they're going to do very well. And if you can just find a few of those businesses, you can do very, very well indeed. And then another thing I think that's quite good, Charlie actually gets most years he gets asked for book recommendations, so I've been using that list. But and another thing he talks about is for anyone that wants to do well in any field, I think Charlie's key advice year to year is if you start early and read a lot, it's difficult not to do well, in his opinion. It's difficult because there's just so many, there are so many pearls of wisdom just throughout them all. And they are in parts I enjoy it all the way through, but they are quite entertaining. I'd say if you're not really, really into it, then it's probably not worth sitting through 6 hours of it a week. But if you are into that sort of thing and you weren't aware they were there, I think it's a resource that
there are a few books which take the best clips from, or the highlights from the over 50 years worth of archives that there are, and sort of condense them if you wanted a summary.
Yeah, so a good book that I read last year is a book called The University of Berkshire Hathaway. And that's two guys that have been going to like every single Berkshire meeting since like 1984. And it's basically just their notes on each meeting and the key points. So if you can't be bothered watching every meeting, I'd say that book's probably a good place to start. And then there's also another guy who's gone through Warren Buffett's letters that he writes every year. It might be like Warren Buffett essays or something, but there's another book where it's just like Warren Buffett's key points from different letters to shareholders, and they've compiled it by topic. But I'd say the best thing is to watch all the meetings themselves, but that is also the most time consuming.
Yes, yeah.
It's interesting. Bill Ackman has actually been to 4 different meetings between 1994 and 2005 and asked a question.
Really?
Yeah,
that's
popped up for the 4th time in 2005. And then who's the Dando investor? What's his name?
Oh, Monish Prabrai.
Yeah, he asked a question in like 2002 or something. Yeah, another key takeaway for me is it's just that staying within your circle of competence. So, for example, like in the 2000 meeting, which was at like the height of the tech bubble, there was a lot of there was one guy who basically said, I've invested in these technology index funds and I've done like 100% this year. So why can't you buy some for us? And he just says, I don't understand it. Some people might do very well, but it's not something I understand. And then another key lesson is that like when they're talking about the biggest mistakes, they only include things that they felt like it was within their ability to understand. So one thing they talk about is, they talked about in like the late 90s, early 2000s, that they regretted not investing in pharmaceutical companies. And they said that whilst they didn't have the skill set to pick the individual winners in the industry, it was within their circle of competence to identify that the industry as a whole was going to do well, and they should have taken a basket approach. And that is a mistake that they consider a genuine, whereas they didn't at that point have any regret over not investing in technology stocks, because they just didn't understand it, and they wouldn't have been comfortable with that investment. And I think that's quite a key takeaway as well.
Takeaway point, yeah.
But
very good.
There is one other thing I wanted to talk about before we go.
Go ahead.
So for anyone that is active on Twitter, or FinTwit as it's known, which stands for like financial Twitter. And if you're not, I'd say particularly if you follow US stocks, there's some really, really good accounts for like the growth stocks. And there's this really good little community on financial Twitter where there's some really great analysts posting some really great analysis, and the amount you can get just for free is fantastic, really. But a lot of these big names on Twitter have actually come together, and they've created a summit that they're going to do this year. So for anyone interested, and it is more of a US focus, and for anyone interested, at some point in 2021, they're going to be doing some sort of summit where it's all going to be online. It's basically just going to be a day of them talking about investing and growth stocks. And some of the speakers that they've got, if you are interested in growth investing, they are very, very good. But if anyone's interested in that, I think they've said it'll probably cost about £6 or $6 to sign up for the day, which, based on the quality of the speakers that they've announced, I think is probably a price worth paying. Well, it is a price worth paying. But if anyone is interested in that, or would be interested in learning more, you can go to @FinTwit Summit on Twitter. So that's FinTwitSummit. And I don't have any affiliation with it at all. It's just that I've signed up, and I think it looks like it's going to be very good based on the accounts that they've got announced as speakers.
Perfect. Well, on that note, I think we'll close it and say we'll see you next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.